Welcome to the deep dive. Today, we're plunging into the Toro Company's latest Q3 fiscal 2025 earnings results and their forward guidance, which just dropped yesterday.
Our mission today is really to cut through the numbers, the corporate speak. We want to highlight what's truly important for you, helping you understand their performance and the strategic path they seem to be laying out.
Okay, let's unpack this then, because on the surface, it feels, a bit like a mixed bag. The Toro Company reported Q3 net sales of $1.13 billion, which is actually down 2.2% from last year.
Right.
But here's the part that genuinely caught my eye. Despite that sales dip, their adjusted diluted EPS actually climbed 5% year over year. It hit $1.24, comfortably exceeding analyst expectations.
Yeah.
That seems like a fascinating disconnect, doesn't it? Sales down, but adjusted earnings up. How do we even begin to sort of reconcile those two?
That mixed bag you mentioned, sales down, adjusted earnings up, that immediately tells us there's a deeper story here.
Okay.
And the key to understanding it, I think, lies in looking at their reported diluted EPS,
Right.
which was significantly lower, just $0.54. This big difference, it points directly to a specific issue. It includes a substantial non-cash impairment charge.
A non-cash impairment charge.
Right.
For listeners who might not be, steeped in financial jargon, what exactly does that mean? And why did it hit their reported earnings so hard?
Yeah, good question. Think of it this way. Toro had previously valued a part of their business, specifically their starting line, at a certain amount on their books. But with the persistent weak homeowner demand in that area, they're essentially saying, look, we have to be realistic here. This asset isn't worth what we thought.
Okay.
So they took an $81 million pre-tax charge. That translates to about $30.62 per diluted share. It's an accounting adjustment, really, reflecting a decrease in the asset's value. It's not cash leaving the bank, but it acknowledges a significant hit to its perceived worth.
Got it.
And that directly impacted the reported EPS number. It immediately flags that, we're looking at a company with strong and weak areas right now.
Right.
And diving into the segments clarifies this mixed picture even further.
Yeah.
If you look at their professional segment, net sales were up a solid 5.7% to $930.8 million.
Okay, that's quite strong.
Yeah, and this growth wasn't just, random. It was primarily driven by higher shipments of things like underground construction, golf, and grounds products, basically, stuff needed for big infrastructure projects and maintaining golf courses, plus what they call net price realization.
Net price realization, I like that term. Does that basically mean they successfully raised prices and those increases actually stuck, rather than getting eroded by discounts later on?
Exactly, that's precisely it. When we talk about net price realization, it means they implemented price increases and were, largely able to retain those higher prices even after you factor in any discounts or promotions. It speaks to the strength of demand and maybe their brand power in that professional segment. And what's more, that segment's earnings margin expanded impressively by 250 basis points, reaching 21.3%. And this boost came from a combination of things. Productivity improvements, that effective net price realization we just talked about, what's known as net sales leverage.
Right, spreading fixed costs.
Exactly. Higher sales volumes spread fixed costs more thinly, plus strategic cost-saving measures and even lower marketing costs. So it really highlights, robust performance where demand remains strong.
Okay, but then there's the other side of the coin.
Yes. In stark contrast, the residential segment, its net sales dropped sharply, nearly 28% down to $192.8 million.
Wow, almost 28%.
Yeah, a significant decline. And it was primarily due to lower shipments across the entire segment, just reflecting a noticeable drop in demand from homeowners. Predictably, this hit profitability hard.
I bet.
The residential segment's earnings margin saw a dramatic decline, over 10 percentage points. It fell to just 1.9%.
Oof. Over 10 percentage points down to less than 2% margin. That's a huge shift. What exactly caused such a significant drop in profitability there?
Well, it was mostly lower net sales volume, obviously, but also higher material and manufacturing costs, some inventory valuation adjustments, and an increase in sales promotions and incentives to try and move product.
Inventory valuation adjustments. That usually means stuff isn't selling, right? They have to write down the value.
Precisely. When products aren't moving as quickly as expected, their market value can drop. Toro might have had to write down the value of some residential inventory, hitting that segment's profitability directly. It really highlights the severity of the demand slowdown. So you can see a clear bifurcation in their business performance.
The contrast is incredibly stark, isn't it? On one hand, you've got this robust growth in professional, clearly benefiting from infrastructure, commercial, outdoor maintenance needs.
Right.
On the other, a significantly challenging environment for residential, reflecting that homeowner caution due to high interest rates and tariffs that we keep hearing about. It's almost like two different companies operating under one roof right now. Given that, does this underperformance raise any questions about Toro's long-term commitment to residential, or are they just riding out the storm?
That's a great question, and it really sets the stage for their updated guidance. Management seems to be saying they are committed, but they're certainly, recalibrating expectations.
Okay.
So connecting this to the bigger picture, they've updated their full-year fiscal 2025 guidance. And it's clear they're taking a pretty prudent approach in light of these segmented differences.
How so?
Well, they now expect total company net sales to be at the lower end of their prior range, which was flat to down 3%. So this adjustment signals a more conservative outlook than maybe earlier in the year, directly addressing that dichotomy we saw.
And critically, their adjusted diluted EPS guidance, that's been updated too, right? To about $4.15, and it's previously a range, $4.15 to $4.30.
Yeah, exactly.
That narrowing of the EPS guidance to just about $4.15 feels significant. Is this just management being conservative, or does it signal maybe a more cautious outlook on their internal operations or market recovery? What's the story there?
Well, this raises an important question, right? Why the adjustment? The company explicitly states it incorporates, and I quote, a reduction in volume from persistent macro factors that are extending homeowner and channel caution more than previously anticipated.
So it is that homeowner caution biting deeper than they thought.
It seems so.
Good.
It includes the ongoing impact of high interest rates, tariffs, things certainly making homeowners maybe more hesitant about big purchases like a new mower or snowblower.
Okay.
And beyond the top line in EPS, there are other important adjustments to note. Their adjusted operating earnings margin is now projected to be flat to slightly lower than 2024.
Oh, wow. Previously, they thought it would be higher than 2024, didn't they?
They did. So that's a meaningful shift in profitability expectations.
Yeah.
Not just a cut, but like you said, a reversal in the outlook. Definitely something to watch. And capital expenditures, those have also been reduced slightly. From around $100 million down to about $90 million. Again, reflecting that more conservative stance on spending.
Okay.
However, on a positive note, their free cash flow conversion forecast has actually increased. It's now expected to be approximately 110%, up from around 100%.
An increase to 110% for free cash flow conversion. That sounds incredibly strong. What does that percentage really tell us about their financial health? Seems counterintuitive with a lower sales outlook.
It's a powerful indicator, actually. Essentially, it means they expect to convert more than 100% of their net income into actual usable cash this year.
How do they manage that?
It's often a testament to strong operational efficiency, how well they manage working capital things like inventory and receivables. It means they're good at turning profits into liquid funds, even in a tougher climate.
I see.
What's also important to acknowledge are the positive assumptions still underpinning this guidance. They're banking on continued strong demand and stable supply for their underground construction and golf businesses.
The strong parts.
Right. And they're also assuming weather patterns align with historical averages for the rest of the year.
Okay, so they're banking on continued strength in professional and basically normal weather. Are those assumptions realistic in the current climate? Or do they represent a potential point of vulnerability if things don't quite go as planned?
That's a fair point to consider. Weather is always a bit of a wild card, right?
Yeah.
But their professional segment has shown remarkable resilience so far. Richard Olson, the CEO, he noted that while they're taking a, quote, prudent approach given challenges in residential, their continued innovation leadership and focus on productivity position us to further improve profitability and shareholder returns as markets recover.
So leaning on internal strength.
Seems like it. They're clearly looking for internal levers they can pull in what's shaping up to be a pretty tough external environment.
Okay, well, that leads us directly to how they're actually addressing these challenges through deliberate actions. You mentioned productivity. One significant initiative is called Amplifying Maximum Productivity, or AMP.
Right, AMP. This is a big one. It's a comprehensive program expected to deliver at least $100 million in incremental annualized cost savings by fiscal 2027.
$100 million annualized. How significant is that for Toro?
It's substantial. To put that $100 million into perspective, looking at their current annual operating expenses, this isn't just minor trimming. It represents a potential, maybe 2-3 percentage point boost to their operating margins over the next few years.
That's a serious lever.
It is, especially in a challenging market, and they seem to be making solid progress already. They achieved about $4 million of run rate savings just in Q3 2025.
Okay.
And they say they're on track for $75 million in annualized savings today. So it's a very tactical move to try and bolster margins from within.
And speaking of costs, they also tackled tariffs head-on, didn't they? They now estimate fiscal 2025 tariff headwinds to be around $70 million. That's actually down from a prior estimate of $90 million.
Yes, that's right.
So what does this tell you about their strategy in mitigating these external pressures? How are they actually achieving that reduction?
Well, it tells us they're being pretty proactive and, frankly, effective. They are mitigating these tariff headwinds through a combination of things. Strategic sourcing adjustments, which basically means finding alternative suppliers or maybe reevaluating where they produce certain components.
Shifting supply chains.
Sort of, yeah. And also price increases. They seem confident they can mitigate 100% of these tariff headwinds for the full year 2025.
Fully offset them. That's impressive.
It is. And their competitive advantages here are noteworthy. They mention things like USMCA qualification for North American trade, having a primarily U.S. supply base, minimal China exposure, and certain ag-use exemptions.
So structural advantages helping them out.
Exactly. Those collectively insulate them significantly from global trade volatility compared to maybe some competitors. Their ability to mitigate 100% isn't just avoiding a cost, it strategically insulates them, building a more resilient supply chain.
Okay, so A&P and tariff mitigation are clearly crucial immediate levers for profitability. How does their big innovation push, those autonomous mowers we heard about, how does that fit into this overall strategy? Is that more of a long-term investment, or does it contribute to short-term resilience too?
That's a critical connection to make, I think. While A&P and tariff mitigation are about immediate cost control, innovation is really about securing future growth and addressing current market pain points. They highlighted a pretty impressive automation lineup in their materials. Products like an autonomous mower with GPS RTK technology.
GPS RTK, that sounds incredibly precise. Can you elaborate on what makes that stand out from just standard GPS?
Yeah, it's a big step up. RTK, or real-time kinematic, provides centimeter-level accuracy.
Centimeter level, wow.
Yeah, think of it as the difference between knowing you're on a specific street versus knowing exactly which blade of grass you're cutting. It's crucial for the precision needed in commercial landscaping, golf course maintenance, places where consistent, high-quality results are paramount.
Okay, makes sense.
So these innovations, they directly address very real-world problems like critical labor shortages in commercial landscaping and golf course maintenance.
Which we hear about constantly.
Constantly. So they promise increased productivity, consistent results, and a solution for the rising cost of manual labor. That contributes to efficiency, even in the shorter term, for their customers.
Right.
And beyond these autonomous solutions, they also introduced new products like the Ventrac 45RC tractor, featuring ADAPT technology for quick deck adjustments, and the Toro Spatial Adjust irrigation control software.
And what's the benefit of that irrigation software? Does it tie into broader sustainability goals, maybe?
Absolutely. That irrigation control software, especially if it's paired with moisture sensing tech, has the potential to really transform golf course maintenance by significantly reducing water usage.
Okay, that's a big deal.
It is. So it's about solving current industry pain points, labor, resource scarcity, and simultaneously creating future demand for more efficient, sustainable equipment.
Yeah.
So innovation isn't just a long-term bet. It's also about offering solutions that make their professional customers more efficient and profitable today.
That makes sense. And it's probably also worth noting their strong balance sheet and free cash flow. You mentioned the conversion rate earlier, 90% year-to-date overall.
Yeah.
Plus, they repurchased $90 million of common stock just in this past quarter.
Right.
That shows clear confidence in their cash generation capabilities, right? And their commitment to returning capital to shareholders seems to reinforce their financial health, even with the residential segment struggling.
Definitely. It sends a strong signal.
So as we wrap up this deep dive, it's clear the Toro Company is navigating some choppy waters. There's this distinct contrast between its thriving professional segments and a, struggling residential market. They're not just reporting numbers, though. They seem to be actively responding to a challenging macro environment through these calculated strategic moves.
I think that's the key takeaway for you, the listener. Their deliberate focus on internal efficiencies, programs like AMP, proactive tariff mitigation, combined with that strategic innovation push.
Right.
It's not just about cutting costs, it's about building resilience, strengthening the core where demand is robust, while, prudently managing areas facing headwinds. All these actions seem aimed at ensuring long-term profitability and shareholder value. It shows that even in a tough market, a company can exert some control over its destiny through smart, targeted actions.
That's a great summary. So as we conclude this deep dive, maybe consider this. In a landscape marked by shifting consumer behavior and these persistent economic pressures, how effectively can a company like Toro leverage targeted innovation and operational agility in its strong segments to truly offset those broader market weaknesses? Can they really shape their own destiny rather than just being defined by external forces? Something to think about.